So, IAS 7, Statement of Cash Flow. This is one of the oldest accounting standards and hasn't undergone any change because it's just perfect. But the big question we ask ourselves is, why statement of cash flow? Cash flow came into the existence because companies make or record a huge profit for the year of, say, $30 million. But you go to the financial statements, balance sheet, and shareholders expect to see $30 million under what? Cash and bank. But they will go there and they see like $2 million. Then they are like, how can you make profit of 30 million and you have a cash of only what? 2 million. Where is the money going? So, you see the thing? On this kind of, what did they use the money for? Why are they doing that? So, it was because of this misunderstanding of the relationship between the income statement and then the statement of financial position that the cash flow statement was developed towards, bridge the gap. So the cash flow statement is to bridge the gap between the income statement and what? The statement of financial position. It is to reconcile the two figures. So how we can reconcile our profit with our cash and cash equivalent is what we refer to as what? The cash flow statement. So in a nutshell, the cash flow statement is going to be looking at all cash inflows as well as what? All cash outflow. So during the year, how much cash did we receive? During the year, how much cash did we pay? That will help us to be able to explain why we only have 2 million cash left, even though we have made a profit of what? 30 million for the year. So what are we saying? Bridging the gap between the statement of profit or loss and OCI and then the statement of financial position is the cash flow statement. Now, in the preparation of the cash flow statement, we break down the statement into three various segments. We have cash flows from operating activities, cash flow from investing activities, and then cash flow from financing activities. In a simple language and straightforward, the cash flow from operating activities looks at the cash that we are generating from our core activities as an organization, period. So the operating activities has to do with the cash inflows and the cash outflows from our core activities as an organization. Now, there are two ways that the cash flow from the operating activities can be prepared. We have the direct method and then what? The indirect method. Funny enough, the direct method is not really used because with the direct method, this is where you look at the cash received from your debtors, cash sales that you did during the year, cash payments to your creditors, all inventories that you have bought during the year. So this kind of information. And hardly will this information be available. So that's the direct way of deriving what? The operating activities. But what we'll be going for most of the time is the what? Indirect method. Where we are calculating the cash flow looking at what? The indirect method. And with that, we are going to be starting with what? The profit before interest and what? Tax. Now let me be careful here. Sometimes we start with the profit before tax. When we start with profit before tax, we do the various what? Adjustments that must be done. And this is where the journey starts. So make sure you follow me carefully. All non-cash items such as depreciation, amortization, impairment, fair value gain or loss. All of these items must be what? Reversed on our net profit. Number one, what does the entity do to depreciation? What is the effect of depreciation on the profit of the company? It reduces our profit. And depreciation is a non-cash what? Item. So when we come come into the income statement, depreciation that has been charged for the year, we add it back to what? The profit for the year. Number 2, amortization has the same what? Effect, isn't it? It reduces our profit, so what do? We come and add it back to the company. Impairment of assets. What does impairment do to profit? It reduces our profit, so what do? We add it back. Remember, impairment is also a non-cash item. Then, if the entity has any financial assets carried through P&L, any gain or loss would have been affected in the what? Profit for the year. So financial assets at fair value through P&L. Any gain or loss, how do we treat it? If it was a gain, what did they do to the profit? They added it. So what do we do here? We less. If it was a loss, what did they do? They subtracted. So what do? We add back. So that is the treatment here. So gains will be deducted, losses will be what? Added back. Are we following the picture? That is the next thing. Then aside these guys, there are a couple of other adjustments that we can make. The first one is disposal of assets. If the entity disposes of an asset, whether a financial asset or property, plant and equipment or whatever it is that they dispose of, they are going to be making profit or what? Loss. If the entity makes profit on disposal, what is the effect on that on the profit?
Just increase our profit.
So what do? We less. Are you getting the idea? So the same thing happens. So profit or loss on disposal of assets. So profit will be less, loss will be what? Added. That's the concept. Be careful here. The profit or loss on the disposal is what goes into the operating activity. But the proceeds from the disposal comes under where? Investing activities. And I'll explain that in a moment. The profit or loss on the disposal is adjusted for in the operating activities. But the proceeds from the disposal is taken to the investing activities. So after we do all of these adjustments, there are a couple of other things we bring. Finance cost. So the finance cost that is charged in the income statement, we add it back. The finance cost that is charged, because remember, what are we starting with? Profit before tax. Meaning interest has been what? Deducted. So what do? We add back the interest. We add back the interest. When we finish with this, we get our figure there, and it could be a positive or a negative. Okay? When we do it here, we will get the net cash flows. We are not done, no? Before movement in what? Working capital. The net cash flows before movement in working capital. And it could be positive or negative. Then we bring the movement in working capital. So what are the things in the movement in working capital? Number one, increase or decrease in inventory. Now I want you to get this concept very well. When we are preparing our cash flow statement, this is what is going to be happening. We are going to be giving the statement of financial position for 2 years. That is the current year and then the previous year. Then we are going to be giving the statement of profit or loss and other comprehensive income for the what? Current year. So when we come to movement in working capital, we are going to be comparing the previous year working capital against what? The current year working capital. So if we are comparing, that is where we can deal with what? The increase and decrease. All this while, whatever adjustments we've been doing so far, we've just been looking at the income statement for the current year. Does it make sense?
Yeah.
Just the income statement. But when you now come to working capital, you must look at the statement of financial position for the current year as well as for the previous year. So let's see. If last year my inventory was 2,300 closing, and this year my inventory now is 4,000, what is the meaning of this?
Inventory has gone up by 1,007.
Inventory has gone up by 1,007. What is the meaning of that?
More money.
Money left
your business. It means you are acquiring more what? Inventory. So if you are buying more inventory, it means cash is what? Going out of your business. The reverse is true. So if last year we had inventory of 1,006, but this year we had inventory of just 800, then our inventory has reduced by what? 800. If inventory reduces, what does it mean? It means we are selling the goods and making what? Money. So what is the next effect of that? It means increase in inventory means outflow of cash. So we deduct it. A reduction in inventory means inflow of cash. So what? We add it. Does it make sense?
Yes, sir.
So increase is deducted, decrease is added. The same thing happens to our people. Trade what? Receivables. What do we mean by trade receivables? Now there is an adjustment here that I've missed, but I'm going to be talking about it in a moment. Government grants. I'll talk about it in a moment. Trade receivables. Trade receivables also the same thing. If last year the people who owe you total 4,200, but this year the people who owe you is just 1,000, what is happening here? Are they owing you more or they are owing you less?
They are owing you less.
So if they are owing you less, what does it mean?
Your cash is more money.
They are bringing you money, so your cash is what? Increasing. So what does it mean? The same effect. So increase in receivable means you are losing money, and a decrease in receivable means you are what? Getting money. So it goes the same way with what? The inventory. Does it make sense? Very, very important. But the direct opposite of this effect is the payables. Because payables is a source of revenue to the government. It's a source of funding to the entity. So last year, this year, trade payables. If the people you owe last year was 4,000, and now you owe them 6,200, what does it mean? What does it mean?
The people you owe.
Last year was 4,000. This year is 6,200. It means your liability has gone up. Are you getting money or losing money?
Losing money.
You are getting money because you are not paying them. So you are using their money to do what? Something else. So an increase in payables is a receipt. So we add it. But a reduction in payable means you are what? Paying them. So you deduct. So payables works direct opposite to inventory and what? Assets. So in this case, increase is going to be added and a decrease is rather going to be what? Subtracted. So trade payables. So that's the concept there. That's the concept there. It stands to mean that any other item of working capital that you see there, please, apart from cash, because cash and cash equivalent will be dealt with what? Later on. Okay? Cash will be dealt with later on. So you deal with inventory, trade receivables, trade payables. Then if there is any prepayment of expenses, you would have brought it there. Now let me see if you can catch it. Prepayment of expenses. What is prepayment of expenses?
Payment in advance.
Payment in what? Advance. So let's say last year your prepayment was 4,000 and this year your prepayment is 3,000. What does it mean?
Your cash has increased.
Your cash has what? Increased. So if there is a prepayment, so increase, decrease in prepayment, what do? If there is an increase, it means you are paying more. So money is what? Going out. But if it's a decrease, it means that you are receiving what? Or reserving your money. The same thing happens to liabilities, always. That will be under current liability in the balance sheet. What's that? If last year your outstanding liabilities was 3,000, but this year your outstanding liability is 1,000, what does it mean?
With money you are gonna, you are paying more.
You are paying more. So when it comes to outstanding liabilities, when they are reducing, it means money is what? Going out. If they are increasing, it means money is what? Coming in. In effect, what am I saying? Prepayment of expenses, you work it like the inventory and what? Trade receivables. But owings or outstanding expenses, you work it like what? Trade payables. That's the concept. That's the concept. Now, so after you deal with the movement in working capital, you get your net figure, bring it here. And when you add this to this, that gives you the net cash flow from what? Operating activities. But remember I said I will chip in something here. Sometimes this is a pro forma, so I may not be able to cover everything. And as you are solving questions, things will pop up. But whatever I remember, I'll be able to chip it in there. If the company receives government grants, what is the effect of government grants on their profits?
It increases profit.
It increases profit. Yeah. So the government grants charge for the year. So Jin charge for the year. What do? We deduct it. Do you agree?
Yeah.
So Jin for the year, we deduct it. Nemo, the total proceeds that we receive from the government grants will go under where? Investing activities. Government grant is recognized as a deferred income and amortized over the economic useful life of what? The assets. So the government grant that we charge for the year is credited to the income statement, which means it will increase what? Our profits. But if we are preparing the cash flow statement, we are going to be what? Deducting it. Nemo, the actual proceeds, the total money we receive during the year will come under where? Investing activities. So that's the concept about that. That's the concept about that. Now, we are not done. I said we will get net cash flow from operating activities. There are two components we've left. What are they?
Interest.
Interest and what? Interest and what? Tax. Income tax paid. So after these two components, now remember something I said. What we say, I told you the finance cost charged for the year, we add it back. If in the question, please listen to this carefully. You have to go to the balance sheet and go under current liabilities. If you go to the balance sheet under current liabilities and you see finance costs or interest expenses opening and closing there, that means you have to prepare interest expenses accounts. Please, do you agree? Or do you understand what I just said? If you go to the balance sheet and you see finance costs or interest expenses opening and closing, it means you have to prepare what? An account for it. So finance interest expense is a liability. So the last year figure will be the opening. You close the accounts, the current year figure will be what? The closing. Then the charge for the year. Charge for the year will come here. This figure you added here, that will come here as what? Charge for the year. Then when you balance this account, this side will be what? Bigger than this side. So the balancing figure will be the interest what? Paid. And this is what you will bring in your cash flow. Does it make sense? So you only do these workings if in the balance sheet or the statement of financial position you have both what? Opening and closing. But if there is no opening and closing, then the same figure you added here, that is the same figure you'll be what? Subtracting here. So that's the two things you must understand. So in some questions you will see that the same figure that was here is the same figure here. In other questions, they will be different. Why? Because of this workings that you are going to be doing. Then the last one, income tax paid. That one too, you do workings for it. And I've told you already about it. So whatever opening balance you have, you bring it, both current tax and then what? Deferred tax. Sometimes it could be an opening balance on the debit side. Then you close the accounts up, you get the balance carried down for both current tax and then deferred what? Tax. Then the charge for the year, you come to the income statement. Be careful again here. In the statement of profit or loss on OCI, there may be two different forms of taxes. What are they? In the statement of profit or loss and other comprehensive income, there may be two different forms of taxes. Jose.
Deferred tax and current tax.
But the net figure is the charge for the year, but there are two places we can find tax. What are the two places?
Come again.
In the profit or loss and other comprehensive income, deferred tax could be recognized in two ways. What are they?
Okay. Taxable and deductible.
Deferred tax.
Yeah.
Deferred tax.
And non-current.
No?
It's in the debit included.
Hey. We are talking about statement of profit or loss, we are talking about debit and credit. Come on, we just did this thing here. I told you that.
Getting the question right.
You're not getting the question. Okay, let me speak again. In care. Okay, I'm saying that in the statement of I'm saying that in the statement of profit or loss and OCI, what do we see about tax? Don't we see income tax in the profit or loss?
Yes.
Don't we see deferred tax in OCI if they charge deferred tax on the revaluation surplus?
We see that.
We see, that's what I'm asking. And when I say charge for the year, no, it could be in two ways. It could be in the income statement and then as well as what? The OCI. Because I don't want you to be blinded that tax until you just look at the profit or loss aspect. In OCI, there will also be what? Deferred tax for the year. And that must come here. So when we say charge for the year, it is both what is in the P&L and what is in the OCI. Very, very important. So when I finish and balance this particular figure, this side will always be bigger than this side. The balancing figure is the tax what? Paid. And that is what you take to the operating activities. Any question? This is the hardest part of cash flow. It's the hardest part. Once you get this part right, you get the workings right. Hey, there's always why you know we try from
This is very, very simple.
It's very simple. This is the hardest part of cash flow. Once you're able to do this part, you are good to go in relation to that. So that is the cash flow from operating activities. Like I said, it's a pro forma, but I can guarantee you some regular customers all the time. Depreciation is a regular customer. Disposal, regular customer. Finance cost, regular customer. These three guys, regular customer. These two guys there, they will be there. So you've got to understand. That's why cash flow to me is cheaper than all the others, you know. You could go and straight up and then go away in relation to that. So that is our cash flow from operating activities.